Okay, then onto your credit side here is you have liabilities, equity, and revenue. Is that your liabilities is accounts payable, so meaning what you owe. So so what the business owes for like whenever they're making their payments out. Equity is basically just retained earnings, what you have in the business. Um, that's if you got um, like $1 million, and then you want to use your draw to take some money out of that million. So these go basically there with each other. Um, and then of course we're just going to keep going down here. Is that so? So your equity is what you have in the business, retained earnings. Revenue is just going to be sales or service. So this is what makes money. Um, you got a service if you're working on a car or something like that. You're going to charge lawn mowing business. You're going to charge for the service. Sales if you're selling something could be anything from Budweiser going over to a new bar or something like that, and then you want to sell them some of your beer, so they say, "Yeah, bring it in because we're tired of drinking the old beer." So now you just made a sale, so that sale goes under revenue, and then that'll come up into your equity later. Uh, and say, let's go back to the liabilities here and say that you have your expense, which is on your debit side. So let's just say that, for example, your lights is $100. Okay. Well, onto your liabilities, accounts payable, what you owe, you're going to also make it come down one line, $100. So you have an imaginary line that comes through here, and you're going to put this in for lights paid, and then matters just how you want to word it. Normally, whenever you progress, it's going to get you'll end up doing your expenses. You'll word your expenses a certain way, and you'll word your liabilities a certain way. But whenever you see it on the graph for your debit and your credit, you won't see D and C. You'll automatically know left side is the debit side and the right side is the credit side. You'll never see debit or credit, but you assume that's the debit and that's the credit because left and right, and they always got to equal. So you see here, these two equal right here. So it's paid. But now there's sometimes, um, let's just say, the next step is say that your payment is 100 for the lights, but let's say you don't make the full allotment. Let's say you only paid 80. So now, even though you have 100 over here for that, you're going to minus the 80, and then you're going to put 20 owed for lights. So that way, that $20, you always put there'll be no dollar marks in like there'll be a dollar mark at the top and there'll be a dollar mark at the bottom. So that whenever you total everything out at the end, because both sides got to equal. But then this here uh, say that the lights bill was for July, and it'll be say lights for uh, yeah, it'd be same thing. Lights for July at $100, but you're only paying 80, and so over here for your accounts payable, you only paid 80, but you still list 180, and then you'll say $20 owed for lights um, for July. So now when August comes around, is that you'll owe $120 because this has got to still balance. So even though you didn't pay the full amount, is that it still has to show that it's still coming into balance. So now the next month after that, you would catch that up or do whatever you need to do uh, to be able to fix that, because that whenever you do your balance sheet, is that you're going to have $20 that's hanging you up somewhere, and you have to go back into your journal and you'll have to find that $20 that's messed it up somewhere. But if you had to make a partial payment and say that you couldn't pay the whole thing, then this way, after you listed it like that, you would be able to say, oh, because in August, it would be 100 again, because that's what you owe. So you would say light bill for August, $100, and then you would show here $100 because you're paying for August, but also you're going to pay the $20. And here on the $20, you say for August here, it would be for light bill for August, and then this would be for light bill for July from owed, like that. So that would fall into that. So these two would then come down, and you see that 120 right here. But whenever you got it all back up together on to the computer program, it would show that you basically paid for July 100. So that would be equal then. Um, I know that was a little confusing there, but just as long as everything stays the same and as long as everything equals out. But you want to go simple terms, so that we're going to recap real quick. Your debits is always on the left, credits are always on the right. They always have to equal. It's on the debit side, you have assets, your draw, and your expenses. Once again, assets are cash, your canvables, like receivable for what you're going to receive. Your inventory is what you have, and your equipment. Your expenses, and then your draw is if you need to draw any money out from your business, and these two go hand in hand here for your draw and your one here. And then your expenses is like exactly what it is: lights, rent, water bill, so forth, like that. There with your internet. And then over here on to the credit side, you have your liabilities, equity, and revenue. And once again, liabilities is what you owe. So every time that you have to pay something, you go here to the liabilities. You list it on the debit for what you're paying, like if it's a payment, or say it could fall under an asset. Also, it could be an asset. It could be a farm tractor, and say that you're paying $1,500 a month. Well, the $1,500 a month will come back over to your liability then and be $1,500 a month. And remember, there's an invisible line that comes through here. These two have got to equal no matter what. And every time you do a debit and a credit transaction on to your journal, it's got to equal. Um, the next thing is that we want to look at the income statement. We'll go over that in the next video. That's going to be your expenses and your revenue. Now, and then, and then your balance sheet is going to consist of assets, equity, and liabilities, because assets equal liabilities plus the equity, and that's your formula. So that'll be it for today. All right, it's that next video that I do, we're going to go over the income statement and the balance sheet. And you got to remember, the balance sheet is going to roll over from year to year, meaning that if you have $50,000 at the end of December, like at the end of December 31st, and say you bring this $50,000 at the end of December 31st, and so what you made total is that on January 1st of 2025, you'll bring that $50,000 back over to start at the beginning of the balance sheet, so they can keep going back and be able to search, and then that way you know where your money is coming from, and then you'll have all of your transactions against debits and credits once again, starting from the beginning of January 2025. All right, so stay tuned. This is Rob. This is Backyard Accounting and Finance, and I will get out this next video for the income statement and the balance sheet. All right, thanks again for watching.